platforms and the transition to a low-carbon economy. Moderating will be David Wood, who runs the Initiative for Responsible Investment at Harvard University. And on the panel is Patrick Bolton of Columbia University and the American Finance Association, and Wade Warner of Davis, Polk, and Wardwell. So I'll invite our panelists to take the stage, if you're ready.
If you turn me on, everyone will hear me.
Okay.
Logistical discussion.
Yeah.
We're going to sit here because they're going to present from there one by one first.
Perfect.
And it would be awkward for us to sit up there and get looked at listening to them present.
That makes perfect sense. Well, then the first presenter I will invite.
So yeah, Patrick, why don't you just go, and then I'll do general comments when we start the conversation.
Thank you.
Thank you, and thank you, David, for inviting me on this panel. It's a great pleasure to be here. And David thought of me because he had come across this paper with this title that I've written with several co-authors. And this paper builds on a conference, a wonderful conference we had a couple of years back in Bellagio, where I learned a lot from David and from Wade. And much of that paper is just putting together the content of our discussions and more up-to-date basic facts. So I will jump in right away in the presentation. I will try and speak quickly and go through them fast because I don't want to bore you. And so I'm targeting for 10, 15 minutes, and hopefully I won't race through them too quickly. So here's the basic outline. Main thing I want to show you is the current context on infrastructure. Hopefully you'll some of the facts I'll show you will strike you as quite amazing. Then I will seg into financing, new models of financing, and the importance of PPPs, public-private partnerships. And then I will move into the important role of development banks, in particular multilateral development banks, and how they see their new role. And that will set the stage for the more innovative discussion on platforms and transition to renewable energy, which Wade will follow up on. So this is, whichever way you do the calculations, this is based on a number of different studies. You come up with estimates of needed infrastructure investments by 2030 of roughly, this is global estimate, global needs of roughly $60 trillion. Okay, and the different colors tell you where the infrastructure is needed. The gray part is roads, and the orange part is power. Just think of those two. These are very important. And this basically translates into a low estimate for how much you need in terms of investment, the gap, if you want, which is about 1.5 trillion per year from now until 2030. It's a huge gap, and these estimates are conservative. They're based on what we know about current spending on infrastructure, and then what we know about how much you should spend as a share of GDP based on historical data, right? So the light green in the middle there box is based on those estimates, and you can see the shortfall is about 1.5 trillion. And if you want a little bit of a breakdown on where those needs are, well, this is a study by McKinsey, the biggest gap is in so-called upper middle income countries, and by sector, the biggest gap is in power. Now, of course, here the gap in upper middle income countries is driven by the methodology. Of course, the biggest gap is in poor countries. They have no infrastructure. But they have very low GDP, so this is why it's calculated this way. But power is where power and transport you can see here, and water is where the big gaps are. The problem is huge gaps in funding. Where is it going to come from? And the problem is post-financial crisis, we know it's unlikely to come from the government sector. from public finances, because here this chart just shows you how much leverage has gone up, especially in OECD countries post financial crisis. So, what's to be done? Well, turns out there is an opportunity. The opportunity is the 100 trillion of estimate, 100 trillion of assets under management that could be deployed to infrastructure. And where are those 100 trillion currently invested? They're invested primarily in government debt, fixed income securities. How much do you earn on those? Well, essentially zero if you have a 10-year horizon. And just to show you how bad the situation is on fixed income, Ireland issued a 100-year bond earlier this year. Okay, and Ireland was a target of a couple of years ago. There's a risk of default, and today the yield was 2.35%. Okay, that includes credit risk. There is so much money in the world looking for savings vehicles, and there are not enough savings vehicles. That's why we have negative interest rates in countries like Japan and Germany. So the money is there, and where is the money? Just to give a quick breakdown, pension funds is a big part of where the money is. Insurance companies, sovereign wealth funds, and private equity, and a little bit in hedge funds as well. And when you look at the different asset classes, asset management segments, you see that all of them, insurance companies, foundations, endowments, pension funds, all of them want to ramp up their infrastructure asset allocations. The one exception is sovereign wealth funds, and it's not completely clear why they want to. Norway recently communicated their sovereign wealth fund, NBIM. They don't want to go into infrastructure. Now, why they don't want to go into infrastructure is a mystery to me. But that's what they decided. And if you want to break down by country, you can see here that the pension funds, especially in Canada and Australia, are very active in the infrastructure investment space. And elsewhere in Asia, you have the Singapore fund, GIC, is heavily invested. You have some Middle Eastern sovereign wealth funds that are also heavily engaged in infrastructure. In Europe, thanks to the Dutch, you have some interest, PGGM and APG. And you can see otherwise in the US and other parts of Europe, there's almost no interest, and that's where you would like to basically build up more interest in infrastructure. And in case you wonder, Canada and Australia, well, there's a big part that has to do with the fact that these countries have very active public-private partnership infrastructure financing models in their country, and of course that gets taken on by their pension funds. There's a fair amount of within country, if you want, financing, whereas much of what we need is globally is funds to move towards what I referred to earlier, middle-income countries and low-income countries. So how do we get there, and where are the bottlenecks? So how do we get there? I can basically say it in two lines. So you have to go the public-private partnership model. There's no other way. You have to go there. You have to make it more efficient. Making it more efficient will involve a number of things. It will involve standardization. It will involve greater involvement by multilateral development banks, and then there are some legal angles also that are important, but I may not have time to touch on those. But very quickly, let me jump here over these questions. I want to get to the new economics of PPPs, and here where a lot of the value creation lies is in channeling more pension fund money, long-term investment money to so-called greenfield projects. And you have one fund that, there are not that many funds that are active in this space, but one very interesting model, which is the Meridian Fund. They have a lockup period 25 years. Okay, that's very unusual. That's a double typical lockup period for private equity. And they're attracting long-term institutional investors. Now, they have enormous potential. What's holding them back? Probably not funding. What's holding them back is not enough origination of new deals. And so that's the other bottleneck where. I will not comment on this slide, but let me just say in quick words, the bottleneck is at two levels. One is that although the technical expertise in putting together a PPP resides mostly in multilateral development banks, and these are World Bank, European Investment Bank, EBRD, and Asia Development Bank, and now the newly created Asia Infrastructure Investment Bank will also attract talent. Although there's a lot of talent, technical expertise there, it's not used efficiently. So that's one bottleneck, and so you want to find out how do we use it more efficiently. That's part of the question. And then the other bottleneck is, maybe this won't be too surprising to you, the other bottleneck is that often the host governments that would be the partner, the public partner, don't have the technical expertise among their civil servants. Their civil servants are not trained to deal with the very, very sophisticated companies, concession operators who have enormous experience, invest all over the world. They don't have the expertise to basically put together these contracts, and so there's clearly a need for executive training and so on. But just to give you a sense of what is needed and what are very good deals, I just thought I should mention, in my view, two among the best examples of what you could do. Okay, so one of them is the Hong Kong MTR. That's the analog of the MTA here in New York. Well, it's the one of the lowest cost subway systems in the world. Hong Kong. It costs very little to ride the subway in Hong Kong, and yet it's a profitable system. And how were they able to do this? Well, the solution is what is referred to as value capture. Basically, MTR is not just a transit operator, but it's also a developer, a real estate developer. And they buy into real estate development rights in areas that are going to be reached when the subway is extended. And of course, then they're able to capture the value added in real estate. It would have been great if we had thought about this in Manhattan with the extension of the Line 7 and then the line on the east side that is been very expensive. The other model I want to bring, I'm told I have only a few minutes left, is this is the other extreme of sophistication. This is really the UK Infrastructure and Projects Authority. They're a model we want to study worldwide. They have been very creative, and in particular, the deal that will go through. I mean, there's been a lot of press recently about whether it will go through, some of the difficulties. It's the financing of the 2 nuclear plants with the new EPR technology in the Hinkley Point plants, which, well, the early estimated, this was like 2 years ago, the estimated costs were 43 billion euros. It's come down a little bit. I think they've scaled it a little bit down, but it's still in the 30 billion range. To give you an idea of how much that is, the Swiss just inaugurated the longest tunnel in the world, the St. Gotthard Tunnel. That cost 11 billion euro. Okay, so this is a much bigger project. It took 7, now 8 years consultation just to put it together, the deal together. Estimated construction time is 8 years, and operating period was over 60 years, lifetime. So you could see not just any investor will come and invest in this deal. It takes incredible sophistication putting a deal like that together, and where the UK government, if you want, play the role of a development bank. This is what development banks can play, the role they can play elsewhere. Where it had a very smart policy is it made the financing affordable by providing a loan guarantee of up to 20 billion pounds. That's about 2/3 of the construction of the total cost. That where because of the guarantee, you can borrow at AAA rates. That significantly brings down the cost. And then the other interesting piece is they have this contract for difference, where they lock in the rates at which the nuclear plant can sell electricity to the grid, and they bring forward the pricing, basically providing insurance. Demand insurance makes sense for a project like that. Some insurance of financing risk makes sense, again, and however, construction risk is taken on entirely by the concession operators, EDF and the French electric utility company and the Chinese partners, because they're charged with the construction. They ought to have the maximum skin in the game for that. So the point is, I just want to illustrate these examples to say where we can go, how we could unlock the potential, financing potential, and go closer to the financing needs of infrastructure globally. And I'll stop here, and Wade will, I think, give us some nuances and show you also different ways of constructing the platforms, infrastructure platforms.
Thanks, Patrick.
And then I think, is this yours? Yeah? No.
There's got to be a technology person around here at Bloomberg somewhere.
So, this is yours, right? Yes. Okay, got it.
I guess we play the slides.
Yeah.
Works. That's great. Thank you, Patrick. I'm Wade Warner. I'm a senior counsel at Davis Polk & Wardwell, a law firm here in New York, where I worked for 45 years. I'm now also a colleague of David's up at Harvard at the Kennedy School, and a lecturer in law at the law school. And I spent most of my career overseas doing public-private partnerships and financing infrastructure. I did it overseas largely because it's easier to do overseas than it is to do here. But we'll get into that in a second. In any event, I'm here to discuss some of the more interesting ways that the development banks and others are trying to find ways to bridge this gap, to match up the appetite of institutional investors for infrastructure assets with the need for sustainable infrastructure assets, and some of the platforms that are going to be developed, that are being developed to do that. Now, infrastructure assets you think about them, roads, bridges, a lot of sustainable infrastructure assets tend to be in the energy space, alternative energy. But there are actually quite a number of other kinds of infrastructure assets that address development goals, and I'm going to talk about a couple of them. For example, there is a movement, a pretty accelerated movement, as many of you probably know, from the dumb power grid, where there is a centralized, huge coal-fired plant that provides the base load for electricity and distributes that electricity to customers, as opposed to the move to a smart power grid, which, through the benefit of a broadband communications network, is able to incorporate wind and solar, local storage, and coordinate the dispatch of electricity in a way that's sort of something like a virtual power plant. It's really a power plant via software. And that is what's coming, and it is going to transform the electricity industry. They're actually fairly scared about it. Similarly, that kind of broadband-supported network can be applied to smart water projects, so that sensors and modulators, a network of interactive controls can be pulled together in a network that allows centralized control of water usage, preventing leakage, dealing with water quality, basically taking much better care of this increasingly important resource. And from a development goal point of view, one of the bonuses of doing smart grids and smart water is that you are building necessarily the communications infrastructure that can be used as the backbone for digital inclusion efforts to bring the internet to people who do not have it. And that has dramatic implications for economic development, education, civic engagement. Now, as Patrick said, there's a huge and growing institutional investor interest in infrastructure projects and in sustainable infrastructure projects, but there's way too much dry powder in the world on this because of a lack of bankable projects, of projects that have acceptable returns on investment adjusted for the risk that is perceived to be in those investments. Oops. Now, infrastructure investments are actually pretty good investments. And the World Bank, for 50 years, has made a lot of money on infrastructure investments. The IFC makes money on infrastructure. OPIC, U.S. government agency, makes lots of money on overseas infrastructure investments. In fact, when Congress wanted to kill OPIC at one point, they decided they couldn't because it would increase the deficit. So these are not bad investments on their own, but they have a lot of perceived risk. And so it's this lack of transparent and bankable projects and the risk that they're perceived to carry that, as Patrick said, is a major bottleneck. And obviously, if you're going to ask people to deal with those risks, you've got to identify them. They've got to understand them. The World Bank is extremely good at, and has great experience in identifying those risks and allocating to the people who are best able to bear them, and thereby creating efficiencies in the financing. Now, infrastructure projects, as I said, are not terribly risky. They have construction risk up front, but usually that's quite manageable. They have some degree of operating risk, also typically quite manageable. Lots of experts do it. You can buy it. The risks that they bear most pointedly are demand risk. Is there going to be traffic? Is there going to be demand for power? Is there going to be water demand in the right places and for the right amounts of money? And political risk. And political risk comes in the form not just of expropriation, which happens, of course, in some countries, but also in the form, particularly in the developing world, of foreign exchange risk. Because you pay for your infrastructure needs, your electricity, your water, with local currency, but if you've borrowed in dollars, you have a mismatch. And that's very difficult to cope with from a local point of view. And as Patrick said, the real key is to get much more investment in the greenfield side than in the brownfield side. And again, the greenfield side is really about the risk of getting permits and the risk of getting construction, and that is a very manageable risk, in fact. Or there are people in the world who are happy to take that risk. for a relatively good price. So this all gets wrapped up, I'm a lawyer, to a hammer every problem is a nail. This all gets wrapped up in agreements, and you can allocate these risks pretty well by agreements. And it's not like these are new things. These agreements have been around for 50 years. And people will tell you that it's very, very complicated, and it is, but it's, and the high priests will all tell you you can't understand it, but believe me, this is pretty standard stuff. It is complicated, but it requires work, and that's the key. The key is preparation. The key is due diligence and preparation early on in the process. And that helps you then figure out which risks you have and how to allocate them. So one of the things that McKinsey has come up with is a suggestion that a lack of viable funding models, especially for sustainable infrastructure, is one of the key problems. Their suggestion, and I think it's a good one, is that once you've identified areas for sustainability, like we were talking about earlier today with a large stream of very low cost and distributed savings, very low savings but widely distributed in big numbers, but disaggregated, you have to do the work to get that done. You have to do the work, the preparation work, to get that organized and put together, and somebody has to pay for that. But there are this is the sort of place where a development bank, or for that matter, impact investors, can come in and take on that risk and get that result, pay in effect for that result. The other suggestion that McKinsey's had recently is this risk-adjusted rate of return question, which is a serious one. The idea is to get these deals to be more like the utilities that they really are, because infrastructure really is a natural monopoly, typically run more or less at a utility kind of rate. And so it ought to bear utility kinds of risk. When I did my very first power plant in China, which was in the early 90s, they said, you should get a return sort of 8 to 12%, kind of like a US electric utility. We said, yeah, but it's in China. And they said, oh, no, that's not a problem. We'll take care of China. We said, well, actually, the fact that you could take care of China is the problem. So the question is, who's going to bear these guarantees? Who's going to take this risk? And this is another place where the multilaterals come in very heavily. They've got a long experience with some of the things Patrick mentioned. Partial risk guarantees. Well, they'll take some of the risks. They'll take, for example, the risk of expropriation. They'll take the risk that the government changes its policy on feed-in tariffs. They will take the risk, even in some circumstances. I've actually worked on a deal where they took the risk of currency fluctuation. Not very many deals like that, but there are a few. And recently, to try and move this along, there's been a development not only among the development finance institutions, as Patrick mentioned, but also in the private sector and public-private partnerships for financing purposes, to try and bridge these gaps. Now, some of these, they're all pretty early days on almost all of them. Some of them are sponsored by governments, some are sponsored by development banks, some are sponsored by philanthropy and private capital, some are just investment advisors, but all of them are trying to address the question of this information asymmetry. How can we get through the due diligence process in a relatively standardized way, make it understandable to a wide range of investors, and catalyze investment in these sectors? Some of them, Aligned Intermediary, for example, has even gone so far as to basically be an active broker who monitors the investment from the start to the finish. Now, at the Kennedy School, I did a lot of infrastructure funds in my day, so again, hammer and a nail. We've decided to sort of take a step back approach a little bit. Instead of a broad initiative with a lot of different players, we're sort of hearkening back to some of what the infrastructure pension funds, the pension funds that want to invest in infrastructure, are saying, which is that they don't want to pay, they want exposure, they want expertise, but the Canadian and the Australian pension funds that Patrick mentioned all have in-house people, experts, just like the World Bank, in making the kinds of investments they make. Well, the smaller pension funds can't do that. So how can we get these pension funds put together to collectively underwrite that expense with a single set of experts that would be their experts? And so we're looking at an infrastructure fund with with a difference from the private equity model, where the fees are 2% management fee on all assets under management plus 20% of the upside. The 2 and 20 rule, which sticks in the craw of most Midwestern pension funds, I can tell you. So they just don't want to pay that kind of outlandish fee. And this investment advisor that we're trying to structure would be one that's a nonprofit. And so we wouldn't have to pay that outlandish amount of money over to investment bankers. We'd pay our experts very well, but that's all we do is pay that. We'd make investments so that we would have skin in the game, but not the carried interest, not the 20% carried interest. We would just be along with the rest. So I think we're testing this model out now with a number of pension funds. We'll see where it goes. Our hope, I'm a lawyer, we have all these diagrams, but the hope is to funnel a lot of that investment, at least in a pilot, in this sort of smart grid infrastructure. Because again, if you aggregate these funds and you say to, for example, a municipality, and many water systems are owned by municipalities, many electricity systems, believe it or not, are owned by municipalities. If they can see those things together, if they can envision a project that builds a smart grid for both their water and their power, they can also address, or at least begin to address on a much more economic way, the question of digital inclusion, because the cost of those networks, the smart grid and the smart water, is all in the laying of the network. The extra couple strands of fiber optic cable, tiny little hair-like strands, to have digital inclusion for the neighbor of the power plant or of the solar panel is minor stuff. So that's what we're working on, and we'd be happy to hear ideas from you all and to take questions.
Why don't we go up here into 3 of those? You can choose whichever chair you want of the 4, if there's a spare. Thank you, Wade. You all can clap for Wade. So we have a few minutes left. Now I can turn my stopwatch off. I'm David Wood, I should have said at the beginning, but it was complicated, you heard. I work at the Initiative for Responsible Investment. We're a research project on responsible investment broadly construed. And infrastructure as an asset class has hit on everything we do all of a sudden. We work with large institutional investors. They want safe, stable returns, but also infrastructure investments that create jobs and that set the place for an equitable, sustainable future. The public sector, as Patrick said, a lot of pressures to engage on different kinds of infrastructure investment, sometimes leading to bad outcomes, potentially leading to good outcomes, and similarly with the development finance world. And then philanthropy loves this idea of platforms which are going to leverage private capital, right? And especially post-Paris and post-SDG, this discussion is how private capital is going to save us all and build a sustainable world. Which we just solved, so I guess we could go home now. But in the last
just
minute,
send your money in.
I want to get at this sort of, this very utopian view of infrastructure investment and what we can get out of the private sector versus the realities. The pension funds I work with, we have a project with labor-affiliated pension fund trustees, and the trustees would love job-creating investments in infrastructure that builds a sustainable environment, and yet they're very fearful of privatization and asset stripping, as the results. So that's one fear. And then the other fear is this institutional push towards brownfield instead of greenfield, and we're trading up the prices of assets rather than doing the development work. So maybe we can start with that, Patrick, and greenfield. And where do you see in your research how the platforms can address the problem of channeling money that doesn't want to take risk into this new place?
Yeah, that's a great question. It's a governance question. And it's where the multilateral in MDB, Multilateral Development Bank, is the key word. Because the multilateral institution will do 2 things. It will, first of all, do the due diligence that Wade mentioned, make sure that all the impacts that the infrastructure is supposed to have are there. That's sort of an ex-ante gatekeeping role, but also ex post, the NDB, Multilateral Development Bank, will make sure that the terms aren't too generous to the concession operator, and that's a big problem. As Wade pointed out, you're building a natural monopoly, you're building a utility, and we know utilities have to be regulated. If they're not regulated, they charge monopoly pricing, and then everyone's unhappy. And that's often been a problem with PPPs, and also it gave it a bad name. So that's one aspect. The other aspect is the political risk that Wade alluded to earlier. So you're a concession operator. Let's say I gave you the example of EDF. Let's say they build the nuclear plant. It's all up and running, and then I don't know. There's a change of government in the UK, and then the government says, "Well, we think this contract for whatever, it's far too generous, and we want to rescind that, and we want to lower the price at which we buy electricity from you." So you're being held up, and at that point, what do you do? And here again, the fact that so in this case, I think in the UK we probably don't think it's going to happen, but should a situation like that happen, it helps to have the MDB behind you, backing you, saying, we're the first one to lose on this because we have the junior investment piece. We guaranteed some of your debt. We're the first ones to lose from the renegotiation. We don't want this to happen. That helps. And then the other part that can help, but I'll leave that to Wade. I'm sure he had ample experience with this, is international commercial arbitration. Now, some governments refuse to go there, and maybe that's one reason why their PPPs don't work, but maybe I'll leave that.
Well, that's right. If they don't go there, their PPPs don't work, and people don't invest in them. Or they invest in them at premium that are outlandish. And one of the real problems I find in working overseas with developers is that if they are in a situation where there's an excuse to get an exorbitant price to win the negotiation with the local government, many inexperienced developers will take that opportunity, and all they're doing is creating political risk for themselves later, because sooner or later the government's going to get sophisticated enough to realize they've been taken, and that's a bad situation for everybody. But what Patrick is referring to in particular are the bilateral investment treaties that many countries have with one another to arbitrate disputes over commercial contracts with governments in a place called the ICSID arbitration is the standard one, but there are many others.
Yeah, and I just want to, again, to go back to sort of the end user, if we're looking at pension funds who have all allocated money into this, very likely to be suspicious of international arbitration as a vehicle to get around local regulations and standards. And one role for the responsible investment community is to define the standards of what makes an investable deal and the social and environmental outcomes that are going to be, the targets of those deals, in order to have some credibility that the private-public process is oriented towards public good.
That's
a declarative statement, but it was
that's a fair point, and that's from one side of it. If you're looking at the government,
I'm trying to represent that.
If the government is trying to if you're trying to say that the government needs to live up to its development goals, that's certainly an important aspect. But typically, you would support that with some sort of payment guarantee.
Yeah.
And the good thing about ICSID is, as the Venezuelans have found to their chagrin, that you can actually get money out of them, a lot of money, and it's not nice to do these things, to take back oil fields when you said that you're going to have them for 30 years. So there are billions of dollars of litigation awards in these circumstances, and they can be also directed, if it's structured correctly, toward the failure to meet goals, sustainable goals.
Right.
As to employment, particularly in the United States, to me that's another reason why brownfield investments have not worked. Mm-hmm. Those were private equity models, which were really turnaround models. The Indiana Toll Road. I mean, the Indiana Toll Road's been there for 40 years. Let's just buy it and jack up the tolls and we'll all go away. It went bankrupt. They borrowed too much money to do it. Whereas if you're going to build this fiber optic network and a smart grid and a smart water facility, you're adding value to that community.
Yep.
And the key is to capture that value, as Patrick was talking about.
So the topic was platforms, or is platforms. We're still talking about them. And sometimes I feel when I talk to practitioners from all sides, from the philanthropy, from the public sector, from the pension funds. The word platform is used as an incantation. You know, a platform is going to solve the information arbitrage problems, the political challenges, all of that. And impact investing as a space is full of platforms that were going to magically marry supply and demand that never attracted supply nor found demand. What do we need to know? It's not a question about the platform design, but more about sort of academic. It's great to have academics looking at this. What do we need to know about platforms and how they function in order to know that this is a path that's going to generate activity, you know, do what Lenore was talking about last panel, sort of, you know, develop investable deals that get to scale?
Do you want to take that first off?
So let me start. I think Wade has a lot to say about the penultimate slide he put up, and I want to give him time for that. So to me, I completely see the point. Incantation. I mean, it's also platform is nice because it's vague. Sometimes you want it to be vague because you want it to be flexible. But I think on the multilateral development bank side, what it means, if it works, is really you are giving access to the deal-making expertise that resides in the development banks. And that's the primary role of the development bank. They're the ones who have the staff that knows who to call up in what government office, that has experience with past deals. And that's what you want to spend public money on. Public money is scarce. It's not well spent where private money is available. It's well spent where private money is not available, and private money is not available to, in effect, fund a public good, because a lot of the deal preparation will never result in a deal, because at some way along the way you find it's not a workable deal, and you spend all this money. Who's prepared to put that money up front? And I think it's the development banks that can do that. But then what makes it work? And this is where I think we're really talking about the future here. It's not something I think has really been worked out by anybody and in a systematically. Is you need to have protocols in place that allow investors and host governments to be matched up with teams and do the
early
preparation, right? That's the part that hasn't really been systematically worked out, and I think that's where the development banks need to go.
Yep.
The key to this is engagement, especially investor engagement. And one of the problems with some of the platforms is there's a sense of perhaps initiative fatigue. There's just too many initiatives. I'm involved in all of them, but I'm not engaged in any of them. And one of the reasons that we tried to move toward the actual infrastructure fund model was because if you're putting money up and you're paying for these, you're going to get engaged. You're paying for this stuff. So that's part of the genesis of that.
Great. We have a couple more minutes, so we'll take a couple questions. Wait for the microphone unless you want to yell.
Cynthia Simon, CDP. When we talk about the pension money, for example, that's available or interested in infrastructure, that's on a global basis. But have you ever tried to look at matching up the pension assets and the constraints perhaps around them that exist from state or local or government regulation with the need for infrastructure geographically? Because some of the incentives that you've talked about also, like jobs, I would imagine that's a very parochial incentive. Like, yes, I'm all for creating jobs, but I want them to be in my state. And so in that sense, the capital isn't fungible on a global basis to the extent that we're thinking that it is. That capital isn't necessarily there, I guess.
So let me try and answer that. I mean, I'm not sure I'll give you a full answer, but in the institutional asset owner space, I think it's fairly heterogeneous. And something I referred to earlier, for example, the Norwegian fund, NBIM. Now, Norway decided not to go into infrastructure. I wouldn't be surprised if at some point they revise that decision. Why would they want to go into infrastructure? Because they can put in money for a 50, 100-year horizon, and nobody else can go there. So they have a natural advantage in holding assets for such a long period and reaping the returns that are going to come quite late. And so where would they invest? They would invest, for example, they would be equity co-investors in greenfield with some companies like Meridian. They could just have an equity stake in Meridian. And that would generate significantly higher returns over the long run than what they're earning now. Because what they're earning now, they have, where would the money be substituted out of? It's the fixed income assets that they're holding now. 40% of their portfolio is in fixed income. As I said, it's earning basically zero interest.
It's the 100-year Irish bonds that they just snapped up.
Yeah. Well, hopefully.
At least that's 2%.
But that's the point. But then you have other pension funds. They can't think of such a long horizon. They can't have lock-up periods of 25 years. So what would they hold? They would be holding debt, senior debt that can be traded, probably investment-grade debt, and that's the other part where the institutional investors come in.
You're saying the matching would be along the capital structure?
Yeah, along the capital structure. The matching will be along the capital structure.
One more
That's
question
right.
rather than an answer. We get one more question in, maybe two if yours is good,
So
Steve.
This is Ben Bingham with Three Sisters Sustainable Management, and I'm sort of a follow-on question. It seems to me that the smart grid concept is really lends itself well to local smaller investments because you're creating a standalone microgrid by doing that. So you haven't spoken about that. I just wondered, is it off the table?
So let's hold off on that. And Steve, what was yours? And then we'll answer and wrap up.
Another incantation that's come out other than platforms is at the Kennedy School in particular is like pay for success or outcomes financing. And I've always thought of those being somewhat related to the possibility of connecting them to infrastructure. So I'd be curious to see if you've seen that connection or not.
So microgrids and performance contracting, and I'll end up on place-based.
The microgrid question is a good one. They're not small investments. They tend to be actually fairly large investments overall because you're putting together an entire grid. And it's typically regional, it's usually a consortium of municipalities that would get together to do this, or electric cooperatives out in the West, for example. So yes, they are small, but they're easily aggregated because they're all the same. And electrons are all the same, and photons are all the same. So that part of it, it's really just a question of, in fact, the bigger you get it, the more aggregated you get it, the less demand risk you take. So there is a real incentive to go beyond the small. But I mentioned that because we were looking at that for our pilot, partly because it's in a new space. It's in a space that's interesting to a lot of these pension funds.
Yeah. Performance contracting, do you have anything to add, Patrick? Pay for success, a term you're familiar with?
I'm familiar with the term, but didn't quite follow the question in terms of performance contracting. For whom? For the experts who developed the project? I didn't quite follow. Who would be rewarded for performance and what performance?
For the developers the government does not commit up front, but rather pays upon the creation of the outcome.
Right.
So you set targets for the smart grid,
Yeah.
and magically that happens, and then it would be how does that happen? Yeah.
Transaction cost-free generation of a smart grid.
One example is energy savings. I mean, the idea of guaranteeing a certain level of energy savings is really a pay-for-performance kind of investment. Because if it doesn't happen, you're going to have to pay somebody for it.
Yeah. I mean, I feel like the development costs of infrastructure are going to make it even harder than the places where pay for success have been elsewise. I just want to end on the place-based question. So I think there's been a couple things that are motivating this discussion from the social investment side of things, the ESG side of things. To handle the place-based question, people have put together regional platforms. So there's a West Coast infrastructure exchange. You try to stitch up California, Oregon, Washington, and British Columbia, and you get enough targeted job creation with enough diversification that you can maybe make it work. And then the second thing that people are starting to hook onto, it's either Paris and its energy, or climate resilience, or more likely it's the Sustainable Development Goals, and you'll get a coordination where the funds have made a commitment to participate in the SDGs, and that's enough of a hook that they can come into things that even don't redound to their immediate beneficiaries' interests. We'll see, but that's kind of where the discussion lasts now. I want to thank Patrick and Wade. They know tons about infrastructure, and I'm glad they shared it with us. Jeez.
Future of human capital data. So I'll invite our final panelists to come up. And moderating this session will be Hideki Suzuki, Bloomberg. And on the panel we have Dara Gallant from Sustainalytics, Michelle Miller from coworker.org, and Scott Drazil from the Office of the NYC Comptroller. So Hideki, I'll hand it over to you to take it away. Thank you.
Whatever. As long as this isn't a hot seat.
How are you doing, everyone? Well, thanks for staying for the last session. And then the cocktail hour is right after this, so 45 more minutes, everyone. Stay with us. Today we are going to talk about the future of human capital data, which is really, really exciting. We got 3 panelists to sort of represent and share perspectives around human capital data. So the first person is Michelle Miller from coworker.org. She's going to be on the data platform, data aggregator side. And in the middle is Dara Gallant. She is representing the investment research side, the user of such data. And then Scott Drazil. Did I pronounce your last name right?
Drazil.
Okay, sorry. So he is representing the investment side to talk about the use case of human capital data. Starting from Michelle, if you can talk about what you do and what your organization does, and also lastly, to share about your favorite human capital data.
Sure, thank you. So just a little bit of background on coworker.org. We are an experimental platform that was founded 3 years ago for worker voice. And we basically support employee-led efforts to change corporate policies in companies like Starbucks, Wells Fargo, American Airlines, and Netflix. We have about 350,000 subscribers. Since we were founded, they have improved policies around living wage, paid family leave, and dress code policies, among many other things. So our first product that we launched with 3 years ago was a really, really simple stripped-down campaigning platform, which allowed workers to create an ask they had of their employers and build networks of their fellow employees from around the world to help them make that ask become a reality. And our second product will actually be a data product. We source frontline worker data in 3 different ways. We source it through data matching on our user base, so matching people who are employees of companies with pre-existing consumer and voter data. We collect data through surveys and polls of our user base. And we also get data from comments made on petitions and on social media conversations. So we're in the very, very early stages of actually figuring out what the data product might look like. And we're engaging in a series of conversations with stakeholders like investors, like the media, and others. And what are the questions that they're asking of this kind of data, and what would be interesting for them to learn? Are we going through the slides here, or?
Actually, do you have the clicker?
I don't have a clicker.
No. Do you have the clicker?
I can just keep going while the clicker gets delivered.
Is this the right slide? Actually, no, I don't think so. This one? Is the right one? Which one?
Oh, no. We have to...
You know what? I could just go and save time.
Okay, I'll give it a...
Okay.
Yeah, sure. So our first experiment with this was with our Starbucks employee network. We have about 28,000 Starbucks baristas from 34 countries around the world. It's 10% of Starbucks' global workforce. And they've run roughly 40 campaigns on our site. And about in September, let's see, that's our site. So in September of 2014, after a New York Times article about the impact of irregular scheduling practices on baristas, Starbucks committed to implement new scheduling policies at the store level. And two critical commitments that they made were that they were going to give people their schedules at least 3 weeks in advance, and that they were going to end the practice of clopenings. And this is a campaign around clopenings that was on our site. Clopenings are when the same worker has to close the store at 11 p.m. and then open the store at like 5 a.m., which effectively means they don't sleep. And it was a really popular issue among baristas. So Starbucks committed to changing those policies, and 6 months later we wanted to find out from our user base if that had actually happened at the store level. So we reached out to our 28,000 baristas and we polled them, and we asked about how their scheduling policies were being implemented. And we published this report with the Center for Popular Democracy, in which we had discovered that almost 50% of people were still getting their schedules only a week in advance, and that clopenings were still happening. What was interesting about the clopenings was that part of the reason they were still happening was that there was actually a glitch in the software that from Sunday to Monday, it like rejiggered the week, and so it was scheduling people for clopenings on that day. And basically what Frontline Worker Data was able to do was help Starbucks uncover a glitch in software that they had bought so that they could fix it and actually stop engaging in clopenings. When we published this data, we got a second New York Times story about it. Starbucks was able to come back and really commit to actually looking at the store level to implement these more fair policies. So that was just one example of us really being able to capture, in a pretty rapid period of time, the voice of workers around how, large-scale corporate policies are actually impacting people at the store level. And so I just pulled together some information on what we know currently about our employee networks, some of the employee networks on the platform. So this is the Starbucks employee network. I really just gave you the brief overview. The most popular issues among this network are wage issues, and dress code issues. The biggest campaign ever run on our platform and ever won on our platform was a Starbucks campaign to overturn the ban on visible tattoos, which was a very important issue to baristas, and something that was not evident to anybody who thought about Starbucks baristas until our platform came around. We also have about 10,000 Darden restaurant employees, and we have seen from them that tipping, worker voice policies. There was a really interesting campaign run by employees of Darden restaurants to have a sit down with the new hedge fund that had taken over the company 2 years ago, Starboard, and Starboard actually reached out to the workers directly on our platform to go ahead and engage in the meeting. And the activism by those restaurant employees around a new tipping policy that was implemented created a spate of campaigns in the sector. There are 9 different restaurant chains where there is this issue where the IRS changed a rule around taxing auto gratuities, which are the tips on parties of 8 or more. And so what the companies did was they passed that on to workers, and they stopped workers from getting auto gratuities, which at the chain restaurants means that you effectively lose like $100 to $200 a week. We polled the workers to figure out how much money they were losing. And so basically what the platform was able to do, and what the data we were able to collect was able to do, was 1, articulate the actual economic damage suffered by the workers because of this change in policy, and 2, help us identify like a sector-wide trend. So there are workers from all of the, Cabrera's, Cheesecake Factory, TGI Fridays, all running the exact same campaign on the exact same issue, which would have been otherwise invisible. We have an American Airlines network, which is one of our older networks. Most of our networks are majority under 30. This network is majority between 50 and 70. It's very active. lots of retirees, and what I found to be an interesting data point about this particular network was that the campaigns got catalyzed during the merger with US Airways. So there were a lot of worker policies that were sort of mushed together during the merger, and people were frustrated with that because they didn't really have a voice in it, and it seemed to be a little bit of a hodgepodge decision. We have a Wells Fargo network, and it's quite small compared to all of our other networks, but very, very active and very interesting. So we've got 3,000 Wells Fargo bank tellers. Those tellers using our platform uncovered that there were these sales goals that were really overzealous at the store level that were basically causing some tellers to engage in fairly illegal activity just to meet the goals. And we have actually catalyzed a bunch of other people that have been doing long-term employee advocacy in the banking sector and the National Employment Law Project to publish reports based on the data we collected from workers around the impact of the overzealous sales goals. And this is just a quick, one of the other ways that we collect data is through user comments. We find out how changes are communicated to employees and how employees are engaging with their bosses through the stories that people tell us in their comments. And one of the comments that we got, Wells Fargo followed Bank of America's lead and implemented a paid family leave policy, but they, unlike all of the other employers, decided to wait 3 months to actually implement the policy, which meant that a lot of pregnant employees just missed the cutoff and found that extremely stressful and frustrating. And so they ran a campaign to get that implemented earlier. And this is, what we learned from folks was that what they were told internally was it was just an administrative challenge to make the change, which really helps people think about how they can run a better campaign to make the change. So basically, just to wrap up, we're partnering with a data analytics firm called Civis Analytics to match back-end user data to actually develop much stronger demographic profiles of people that are active on our site and in our employee networks, and to also start doing both wage profiles and household income profiles, so we can have a much better understanding of the amount of money people are taking home from their direct jobs and from direct employment, but also what kind of household wealth they actually possess, based on whether they're married or they have kids or where they live, which we think could help us start to analyze the personal economic impact on people's lives of what's happening inside their own companies. So I'll stop there.
Great. And then your favorite human capital data?
Oh, my favorite human capital data.
It's okay if you don't
Yeah,
have one.
I
All
don't.
right. Okay.
I just- I
we'll
love
skip
them
that
all,
then. All right.
so.
Cool. Okay. So we'll move on to Dara.
Sure. Hi, everyone, and thank you so much for including me. I'm Dara Galan. I work for Sustainalytics. Is this working? Which is a global research firm specializing in environmental, social, and governance research and analysis. We've been in business for about 24 years, and we work with a very broad range of investors and companies, actually, to help them really look at and integrate environmental, social, and governance factors into the investment process. We have about 120 analysts globally who collectively research, analyze, and rate approximately 7,000 companies, comprising most of the major global indices. So for our research process, in addition to the analysis, the written analysis, our analysts are rating and scoring companies on a scale of 0 to 100 based on a set of global best practices, which are then weighted and aggregated on an industry-specific weight matrix to come to an overall rating for the company. Our research is structured along management, which would include disclosure, policies, management systems, and performance indicators, which we divide into environmental, social, and governance themes. For human capital, we would be looking at a number of different indicators, again, including a set of core indicators which would apply to all the companies in our research universe, and sector-specific indicators which would only apply to specific sectors, which would be looking at policies, including discrimination policy. We'd be looking at freedom of association, working conditions, discrimination. We're looking for programs around how the company is managing diversity issues, human capital development, training and development more broadly. We are looking at performance indicators that would look at labor relations, employee turnover rates, for example, as well as any controversies. So for controversies, we're looking for any issues that would indicate that a company isn't managing its operations well, and we would be rating those controversies on a scale of 1 to 5 to give our clients a sense for how severe we think the issue is. We also are factoring into the company's response to the issue and so on. And so forth. So, we rely heavily on media reports. We are processing 2.5 million articles a day. I'm not kidding. Yeah, no, I can talk about how we do it if you want to get into the nitty-gritty. We rely heavily on company reporting as well. So we are looking at all corporate disclosures. We look at approximately 200 pre-screened NGO sites that we've selected and approved. And we're really looking for data sources that are consistent. We are evaluating the data sources we use to see, is there a minimum standard applied? Is the data monitored? Is the data verified? Can we get reasonable access to the data? Is it something we could incorporate into our analysis and redistribute to our clients? Is there a broad enough data set so that we feel we are getting accurate, representative results? Is the data consistent, or is it a mix of numeric and text values that would make it difficult to compare across a large group of companies? So, we also work very closely with companies. So with apologies to Mary, who I don't know if she's still in the room, we're one of the organizations knocking on her door, driving her a little batty. So how do we do what we do? So we think that what is most material or most relevant for a company really depends on the industry that the company sits in, and I think that's really important. We heard that certainly earlier, when Michael was talking about SASB and the work they're doing. So we're very, very similar in terms of how we structure our research. We're really making sure that the issues we look at are relevant at an industry level, and I can give you a couple of examples. On the one hand, you have food retailers, where you have a lot of exposure to a low-wage workforce. You would have a lot of potential issues with discrimination, with labor relations, with union relations. You're talking about an industry with wafer-thin margins, where there's been a tremendous emphasis on cost-cutting measures, and labor is their number one expense. And on the other hand, customer interactions, customer experience is highly, highly connected to how motivated and engaged your employees are. And so, that there's a lot of challenges there. But then you look on the other extreme end, and you would have integrated oil and gas companies. And, you're talking about operations when you're getting out on some of these rigs that run over $1 million a day. And you're highly reliant on a very technically specialized workforce that's working out in remote, sometimes dangerous conditions, where mistakes can cost you hundreds of thousands of dollars a day. And so really the emphasis needs to be on maintaining and properly training that workforce. So that's just a little bit of an overview of what we do. Human capital is it's an interesting area. It's certainly human capital analysis is one of our newer indicators. Really is reflecting a lot of the trends we've been seeing over the last few years. A lot of the emphasis that companies are now placing on the importance of engaging with the workforce and developing the workforce, training the workforce. So it's certainly look forward to that conversation. I'm not sure. I think I don't really have a favorite. We rely pretty heavily on media reports. I think we'll get into
Bloomberg.
Bloomberg. Well,
I hope.
Well, Bloomberg had an excellent article about a week and a half ago about how GE is moving away from the annual pay increase and an annual performance review. So yes, absolutely, Bloomberg, cutting edge. So.
Great, thank you. Well, thank you, Dara. So we'll move to Scott.
Sure, thanks. So maybe by way of quick background, I'm here on behalf of the New York City Comptroller's Office, who's the asset management for the 5 New York City pension funds. So we have about $160 billion in assets across teachers, police, firefighters, Board of Education, and other New York City public servants, sanitation workers, so forth. We are, by our nature as a pension fund, extremely long-term investors. We're investing for future generations of police and teachers. So basically, as long as there are teachers and firefighters in the city of New York, we're investing to try to cover the liabilities of those future payouts. We're also extremely diversified as long-term investors. So we own shares in over 10,000 companies in public equity markets around the world. And as diversified and long-term investors, we're really advocating practices that we believe will deliver long-term, stable, sustainable returns, and also protect against any risks to our long-term kind of investments in these companies. So I really welcome this discussion today. Human capital management, I think, is a fascinating and growing topic. The reality is we always hear companies pronounce that workers are their most valuable asset, right? Or some kind of variation on that platitude. But the reality is we have very little insight as investors into what that means. Mercer has estimated that, it kind of varies by industry, but 36% of revenues can be going to human capital costs. That's rarely unpacked for us as investors. What does that actually mean? In the US market, I'd characterize that there are probably 3 failures in a lot of disclosure around human capital. We do get some information in 10K on the number of employees, or perhaps the number of employees who are part of a collective bargaining agreement. But there's very little more. To the extent we get more, it tends to be very compliance related. Health and safety issues, labor law compliance risks. So it's kind of treating human capital more as a risk mitigation factor than a value driver for the future growth of the company. I'd also say that we end up with a lot of platitudes towards culture. And there's some great companies doing great things with their workforce, but they'll attribute it to, we have a great culture. And for us as investors, what does that mean? What are you specifically developing in your culture that is actually helping position you for future long-term success? The third difficulty and challenge, I think, in the US market is that we don't really get data that's comparable. It's not standardized. It doesn't really allow us as diversified investors to really look across the whole market. So what we're doing with New York City funds in conjunction with 24 other investors right now is working as part of a coalition to explore kind of the question of human capital. It's being led in large part by the UAW Retirees Medical Benefits Trust based in Ann Arbor, a number of other asset managers and pension funds and others that, including Nathan Cummings Foundation, who's has been here today. And I think what's driving the interest is really to unpack this black box. We see what happens when things go wrong in our portfolio. You can kind of cite large mass market retailer that had a sales commission based workforce model for a number of years, got a lot of pressure from analysts and some investors as well to why not lower those costs by switching to a lower wage model like your competitors. Did so on a relatively fast basis and ended up going very quickly into bankruptcy. It's kind of an oversimplification, but basically what happened is that they discovered that their consumer base, their clients, actually liked that their sales force was extremely knowledgeable about the product, and so relied on the sales force to really deliver and guide them through purchases. When that wage model changed, they lost the sales force, and by losing the sales force, they lost their customers. And what happens? Workforce lost, the company lost, and we as investors lost. So we know how things can kind of go wrong. BP, other examples of human error and other issues. We lose value. So what we're asking companies to do is, I guess, three things. One is articulate the materiality of human capital to your long-term business strategy. Like anything, we're asking companies to be very clear about what is your business strategy for driving long-term sustainable value. And for human capital, what role does human capital play in driving that? What are the material drivers or the material metrics that will deliver that sustainable value creation. That can be a range of things. It can be turnover, it could be employee engagement, it could be retention models, it could be training and a variety of kind of development spend. What is it for your particular company and your strategy? I think that the second area is what oversight are you exercising on these metrics? Is the board reviewing this information? We have had some positive stories where a company moved from more of that compliance-based mindset of looking on a quarterly basis at diversity. Then the next quarter they would look at health and safety. The next quarter they would look at some of their store turnover numbers. And then at the next board meeting review some different financials, so forth. Instead, they've now moved to a scorecard basis or a matrix basis, at which on a regular basis they're looking at all of these metrics and the financial results and trying to make sense of them. It's a retail company as well. Are the company where we have better same-store sales? Are there correlations there that are meaningful with retention, with turnover, with our training spend that could actually lead to some insights for how we could improve sales elsewhere in the company? I think it's a very, very kind of positive model. And then the last area, of course, for us, so we've got articulate your material drivers for your long-term business strategy, board oversight, and oversight in general. And then the third area, I think, is disclosure. What out of that should be disclosed to investors? Tell your story. We know that it can vary by industry. It can vary by business strategy. Somebody might be pursuing a very high-wage, high-road strategy. Somebody else just wants to be competitive. Can you be clear on that to some extent? If a company's not telling the story, Sustainalytics might be talking to the press and others and telling that story for you. Coworker.org could be opening up the mic, for the workers to tell it directly. See some interesting academic literature that's actually using Glassdoor to look at employee reviews and what insights that actually says about the quality of engagement of a workforce. But on top of that, we think it's behooves the company to articulate their own strategy and some of the material drivers as well. So it's a process in development. I think that we have really no space to go but up and beyond, since we're dealing with a dearth of information at this point. But really welcome the discussion and the focus on it today.
Great, thank you very much, Scott. I think that what you mentioned in terms of unpacking the black box and everything, I think that's a great segue into the next topic about the human capital. So I think those of us who are in the ESG space, and in terms of ESG's S, we are sort of trained to look at companies' filings data and then look at the employees' figures, employee pay, employee turnover, those things. But Michelle, maybe you can talk about the community-based S data. And for those that are trying to look at your organization's data, what kind of things that you collect can actually tell in terms of companies' human capital management success and maybe failures also?
Mm-hmm. Yeah, so we're, there's sort of the really dry back-end user data that tells us the very specific stuff about where people live and how much money they have. And I think those things are very important. But what I think is much more interesting is what we're learning through user comments and through campaign trends on the site. So one example, there's a company that currently there's a campaign at the Publix grocery store chain so that everybody can have beards. Can't have beard if you work at Publix. And they have 10,000 workers who've signed it. And it seems pretty cut and dry and just like, okay, whatever, moving right along. But what we started to see in the comments on the petition was that the African-American men who were signing were prone to a skin condition that made shaving very painful and dangerous, and were systemically having their doctor's notes denied by their managers. And we were able to pull that data out through a series of comments and start to detect these patterns of maybe store-based, I'm not saying this is, we're investigating it now, possibly store-based discrimination that was baked into this, like, these sort of scattershot comments that were coming in from all over the country. And for the workers, they were able to see something that was happening to them that felt very individualized as part of something much broader. And for the folks that we're talking to who are helping them determine if this is really a pattern, this was something that seemed to be a company-wide issue that the company might actually want to address. And so I think that when you create a place for people to share the story of what is happening to them in a free way, and to really articulate something without overly directing it, you start to surface patterns that are happening across these companies. And I find that to be, we're working with researchers at Columbia right now to basically develop a taxonomy of our user comments and of our social media conversations, and start to track those kinds of patterns, and also start to figure out how we can much more simply categorize and characterize the kinds of things that we're learning. And I will just say one more thing, which is that I say this all the time. I sound like the biggest cheerleader for Starbucks, but so we have 40 campaigns by Starbucks baristas on our site that might on the surface indicate that there are lots of problems at Starbucks, but the truth is that if you have a workforce that feels really free to discuss the things that are going on in your company out in the open, you have created an environment where people feel somewhat safe and not scared of you. It is the companies where you're like not hearing anything that you should really put some thought into. So I am often, Cheesecake Factory workers talk a lot, must be okay to work there. So we can see those are sort of the things that you can't actually see in the hard numbers, but are that sort of qualitative, like cultural data that tends to come out when you're in a space where workers are able to share really freely with one another.
Okay, great. Yeah, thank you. In terms of the sort of continuation of that, and then talk about the community-based S data. So Dara, so let's say something like Glassdoor.com. Anybody familiar with Glassdoor.com? Yes, everyone, most likely. Okay, great. Yeah, so something like that. They have the employee, satisfaction, pros and cons of working there, to CEO approval, pay info, something like that. So let's say if the company has 5 stars, for example, and then that's great. So happy employees, higher productivity, hence great for investment, or the opposite. If it's 2 stars, is that too sort of simplistic of an analysis around human capital using sort of community-based social data?
Simplistic. I think unquestionably there's value in this data, and I think if you look at top surveys of top executives, top CEOs, they will tell you that employee engagement, culture, the retention of high talent employees. I mean, these are all top issues that CEOs will talk about. I mean, unquestionably, human capital is critical to companies, but it's the how and the why where it gets complicated. And there's tremendous value in these aggregated data sets. And I think the reality is that these social media-driven big data sets are driving transparency to a level that we've never seen before, and how companies react to that, I think, is absolutely critical. And I think there's a couple of things investors can think about here, and Scott's absolutely right. There's a black box, and if you survey CEOs, many of them will say that culture is important, but can't define what the culture of their company is. And I think, to Michelle's point, I think in some cases when you're talking about materiality of some of these issues, it can differ by the company, not even at the industry level or the sub-industry level. What issues are really driving employee satisfaction and engagement at a company level? It can be very specific. And so investors can use this data to take a peek behind the curtain and see what's there. I think the other thing investors can be looking at or thinking about, how engaged are companies in actively looking at and responding to the type of information that's coming in through these channels. These are new channels. These are new ways to engage with employees. And because it's anonymous, because it's social networking, I think you might be seeing companies are far more comfortable reporting how they really feel on these sites. Many companies lack formal engagement efforts with employees. They lack the channel to take this kind of information in. And I talked about GE moving away from the annual review cycle, but I think it really reflects a trend that companies are realizing they need to be engaging with their employees continuously. And they really need to be paying attention to what's happening and what their employees are saying about them. And they need to be actively managing their reputation. We're in a job seekers market. It's harder to find employees. It takes longer to bring employees on. Employees aren't staying as long, so your hiring and retention costs are higher. 30% of the workforce now are made up of millennials. Actually, I think it might be higher than that now. And millennials are different. What they're looking for is different. I will say one more thing. I think sites like Glassdoor, the aggregation and the transparency in pay, I think is going to be a critical issue. And I know we hear a lot about gender pay disparity, and I really think there's actually going to be a groundswell of litigation. I think there's going to be a huge amount of effort, attention paid to this issue. And just out of curiosity, are there any lawyers in the room? Just one? Okay. So the gender pay gap in the legal profession is 57%. So could you just think about that for a minute? All the lawyers out there who realize all of a sudden they're making that much less money than their coworkers. So, I think there's a lot to think about, and I'd love to talk about that a little bit more, but I'll stop there.
Okay, great. Thank you. So the last question, I guess, for Scott on the investment side. So how do you actually value human capital, and how are you actually using the quantitative data to try to value human capital, and what kind of conclusions that you can make from it, whether it's the buy, sell, or hold, or everything else?
Sure. So, for us, we're on average the funds are about 80% passive. So we're largely indexed investors, both domestically and overseas. So our approach, to this issue really is for our own risk mitigation and to identify value drivers that can accrue to the benefit of the funds for many years to come afterwards. So we're not actively selecting human capital strategies at this point. Investors might want to jump into that space. But I think for us, it's our own risk mitigation. It's our own kind of attempt to identify an unknown aspect of our investment strategy and to seek better, clear information. Basic belief that markets with better information tend to do better, right? So that's our approach at this point.
Okay, great. So this is going to be actually the last question before opening the questions to the floor for everyone. So since this is the future of human capital, so let's talk about the future a little bit. So things that are going on with the organization, Michelle, and then Dara, some of the cool things that you guys are trying to do around human capital data, data collection, analysis, and then after that, Scott, maybe you can share about your wish list of the data set, the cool data set that you want to be able to use, but it's not readily available, but some of the shops may be working on that. So, Michelle, please.
Sure. So one of the things that we're experimenting with right now is, obviously we're experimenting with the collection and aggregation of the data, but we're also identifying the impact of redistributing that data back into the workforce on a consistent basis to see how that. My co-founder would say that we're trying to diminish the pejorative ignorance of folks. So everybody sort of has an idea of something that they might want to change or something that they're seeing. And if we send them back the aggregate data of the sort of universal worker brain, how does that change the way in which they engage with their bosses or make demands on their employers and launch campaigns? Sort of just creating a data cycle in addition to also sharing that package data out with the media, seeing how the media reports on it, and building our other partnerships. So I'm really excited to see how workers themselves having access to this data is going to change the way in which they engage in their own workplaces.
And then they can benchmark and compare to comparable companies. That's great. Dara?
Yeah, we've been looking at this data, the Glassdoor, coworker.org, and other sites, and we would love to be able to use it. It doesn't fit within the model that we've traditionally used, and we have concerns about the data set and the authenticity of it, and how it's standardized. And we've been looking at it quite a bit. I think some of the more promising work we've been doing is actually around aggregating the data and tracking it over time to look for changes in velocity. And I think that's one of the interesting things for us. We look for indicators. We look for, when we can't get specific data, we look for proxies to try and guess what's really going on. And I think one of the interesting ideas is tracking velocity. So there were 2 negative reviews on this company this week. There were 4 the following week. There were 6 the following week. There might be something going on here. My wish list is just more information, and I really think I would really like to see companies be reporting and disclosing on this more and talking about it in a real way, to Scott's point. What is material to them? What do they think is absolutely, how are they engaging with their employees? How are they ensuring that there is a consistent culture and that employees feel a part of that culture and engaged in that culture. We also want to see companies actively looking at pay disparity issues, because these EEOC rules do go through in September of 2017. We're going to see a lot of reporting, and I want to see how companies are addressing some of those specific challenges. Our research suggests that companies just aren't prepared for this. We see less than 50% of companies are reporting on any kind of diversity or employee-related programs, policies. It's very difficult to see what they're doing. And of those that do have management systems in place, 20% of those are weak. And we really don't think they're adequate at all to address the challenges our industry is facing. So, again, more disclosure, more company information, and some way of standardizing some of these S data sets.
Great.
Yeah, so I think the wish list is definitely for more data. I think Mercer estimated that only 20% of the largest 100 companies are providing some basic information. So we have a lot more space to go. I'd want that data to be reliable, timely, and I think material, really connected to the company's business strategy. If I could add a fourth, perhaps easily accessible, so perhaps Bloomberg could jump
Hopefully,
and
yes.
expand that space, I imagine. We do have to also carefully balance the interest in keeping the data pertinent to a company's specific strategy, while also standardized to some extent. There's currently SEC is doing a review on concept release SK. There's going to be some feedback on that. Some folks are going to push for standardization, increased disclosure, including on human capital. That might be fine and good, but I also want to see companies step forward and tell their own story as well on what's critical to them. So perhaps there's a degree of comparability, but I want to avoid rushing into the space that we end up with more standardization of metrics that aren't necessarily telling us what the bottom line implication is of the data. So that would be my one caution on that wish list.
Okay, great. Let's. Do we have time for one question, one or two, maybe? Yeah.
I actually have 2 quick questions.
Okay. Oh, there's a mic over there.
2 quick questions. Michelle, how do you think about selection bias? In other words, you said something that I kind of thought might have been counterintuitive, that the really happy people would be responding on, through social media. I would have thought just the opposite, actually.
Depends on what site you're on.
Pardon me?
Depends on what site you're on.
Yeah, right. And I'd like to know what conclusions you draw from issues like that. And the second's for Scott. Are you looking at these metrics because you're thinking about the 20% of your portfolio that is actively managed? I didn't understand how you're using these. How is using these metrics consistent with a passive strategy?
Sure. Okay, great. Thank you. Sure.
Yeah, so selection bias we're really new at this. We've only been doing it for about a year, but it's something that we think about quite a good bit. So I would say that right now what our selection bias would be people that are interested enough in staying in their jobs that they're actually willing to go through the trouble of trying to change the thing that's bothering them. So they're not the most angry and disgruntled, but they're also not like the Pollyanna, but I think that the real trick will be as our networks grow and as we have more and more people in the network, I think that that'll reduce the selection bias a little bit. So right now, it's really honestly like the most energetic, sort of leadery type people. I will say, though, that the selection bias came in pretty strongly with our Uber network, which I didn't talk about because they're not publicly traded, and I think. But we had about 5,000 Uber drivers. And after they cut fares in 60 cities in January, and we sent out a survey, and it was like the most responses we've ever gotten to a survey. And it was because people were furious. And they had on average, the respondents to our survey had on average lost $100 to $200 a week in wages because of the fare cuts. And we knew that data was skewed pretty significantly. Because it was immediate, because the people who were most likely to answer that survey were the ones that were probably the most impacted. And so we didn't spend much time actually trying to get people to report on it because we knew that it was a little skewed. We waited another month and a half and then did another survey, which was a little bit calmer. But I think we're going to have to really, it's a great question, and I think we're going to have to really noodle with figuring out where selection bias is coming in and where it is. Also, just one last thing, we're going to be consistently polling people like every month, and I think that's also going to reduce a little bit of that.
Okay, great.
I wondered, you're capturing a younger demographic, more comfortable with social media, and I'm also wondering the older folks who have been in the company longer, which might imply that they're happier because they've stayed.
Yeah, that's a really good analogy.
Okay, maybe that's for the cocktail hour questions, maybe. We can, yeah.
Well, I will just one quick point. I mean, the sites, coworker.org and Glassdoor, they're a way of finding this information, and in the absence of any structured communication channel, there's certainly a way that you can see what's going on, or that employees have a way of putting this information out there. What I really think needs to happen is that companies need to be able to do this in a structured way, where there is a way for employees anonymously, continuously, to be talking to management about the issues that are important to them, and for management to be thoughtfully taking those issues into consideration. And so, but again, and not to say that it isn't important what you're doing, it is. I think it's incredibly valuable for motivating employees, but there is self-selection when somebody is going to a site. The other thing you're starting to see are companies are actively encouraging their employees to get on these sites and give reviews. And so now you have to sort of wonder what percentage of employees on these sites were incentivized in some way to get on there.
Interesting.
Oh, no, I mean.
Thank you. Sorry, very quickly, Scott.
Sure. The simple response is because we are largely passive and indexed, we can't do the Wall Street walk and sell. We're exposed to all these companies, so we generally try to engage companies to promote practices that are better correlated with better long-term returns. So that's governance structures, it can other accountability measures, and I think this one is where we have little information, but we're trying to figure out what will be better aligned with better long-term returns.
Great. So sorry, I think we're running out of time, so we'll continue this conversation over there, over cocktail, listen up a little bit, and talk about your pay with us, and how happy you are with the current employees, maybe. So, well, thank you very much.
Edge of ESG investing. We really appreciate it. So we are going to head over to the cocktail reception now. Before we do, I just wanted to share some quick thank yous. First of all, to all of you for coming and spending the day with us. I hope you all learned a lot and have some good takeaways. I know I certainly did. And I also hope everyone made some good connections and can continue these conversations, not just at the reception, but beyond, so we can all keep working together to move this field forward. I want to thank our hosts at Bloomberg. Once again, Curtis and Lenora and their whole team, and also the event staff who might not have seen it as much today, but have done a great job with the logistics and keeping us fed and caffeinated. So I'd like to give all the folks at Bloomberg a quick round of applause for hosting us today. I'd also like to thank Andreas Hopner again and the ICMA Center at the Henley Business School for helping to pull this event together. Tony at the Intentional Endowments Network, and the interns who have been helping us out, who I mentioned earlier. And most of all from our team, Sonal Mahida, who did the heavy lifting for us. Thank you very much. And one last final round of applause and thanks to all of our speakers for engaging such a great conversation today. Thank you. So let's head on over and keep the conversation going.